Hello and welcome. You're watching Market Wrap, an initiative by ICICI Direct. And here we talk about the week which has gone for the markets and how will the next week be for the markets. And we have a very special guest with me, as always, Mr. Pankaj Pandey, Head Research, ICICI Direct. Welcome, Pankaj.
Thank you, Geetu.
Pankaj, markets are consolidating in a very broad range. We can say it's a volatile consolidation. Today, we saw a very volatile session with Nifty moving in the range of 400 to 450 points. What's happening in the markets?
I think largely, see, the bigger worry for the market is coming largely from the global perspective, especially the US bond yields have eased up. Despite the Fed commentary overall that the GDP growth rate is expected to be good, their bond buying program is intact. Inflation, though, could be higher, but would be tolerated. But somehow the bond market there, the yields have inched up, and that sort of led to decline in technology stocks there. And that weakness sort of percolated in our markets also. But largely, our market weakness was more than what we had seen in the global markets this week. Largely also because of the fact that the COVID cases in India is going up. And you see sporadic cases where probably there is an expectation of some more stringent measures which the government will take. And that might impact businesses for some time. So all that is sort of leading to some bit of a overall cautiousness or an extended sort of a profit booking, what we are seeing in the markets. Because this is the first week where we have seen correction in the mid caps and small caps. Otherwise, broader markets have been outperforming the markets overall. So extended consolidation is expected to continue for probably next 1 or 2 weeks.
If we talk about the broader markets, small cap has ended down 4%. How worrisome is it? I mean, everybody was expecting now mid caps and small caps to move.
So like we have been saying earlier also, mid cap, small caps look structurally very positive, largely because 2 years they haven't really sort of done much. This is the year where they've started performing. And typically, large mid caps and small caps do a lot more better when the economic rebound is there. And I think all your leading economic indicators are pointing towards a healthy economy going forward. I think the tax collections also have been pretty robust overall. So all that is sort of pointing towards a pretty good amount of rebound in the overall economy. So from that perspective, I think whatever correction we are seeing in the broader market, especially mid caps and small caps, I think is a buying opportunity to lap because overall, I think once this sort of weakness subsides, I think the broader market of mid caps, small caps will keep doing well.
Pankaj, if we talk about the Nifty, we saw a correction of nearly 7 percentage points on Nifty, and now today's bounce back has been a little positive for the markets. If I'm a retail investor and I really have been left behind, I didn't participate in the previous rally, and now I want to get into my portfolio making. Which sector, which stocks would you suggest right now?
So largely, if you look at in the last 6, 7 or 1 year, we have seen a decent amount of sector participation across. So initially, it was the defensives which did well when the COVID was at peak, because these were the businesses which were expected to be least impacted in terms of earnings because of COVID. Subsequent to that, as the economy sort of overall bullishness came back, I think private banks did a lot more better, and after budget, we had seen infra players sort of doing substantially well. And after that, mid caps, small caps also have started sort of performing. And lately, we have seen PSU banks or the PSU lots sort of doing well. In fact, some of the PSU lots have done well this week as well. So if you look at in the last 8 to 9 odd months, there is a fair amount of sector rotation which is happening. And our sense is that with most of the sectors having performed, I think, again, you will see a reversal of defensive sort of doing well. So especially IT, pharma, FMCG look far more attractive going forward because FMCG also has seen a decent amount of price correction and time correction. And same is the case with pharma, and IT has been sort of doing well. I think IT structurally is doing well. I think so overall, I think defensive sector is what one can look at again if they've missed the previous cycle, because our sense is that once these stocks sort of do well, and then probably the other sectors will do a catch up. I think Reliance is also, I would want to sort of mention is that this stock also has seen a decent amount of price and time correction. So it is looking good. So I think the defensive plus Reliance look attractive, and I think these are the stocks or the sectors or stocks in these sectors is what one should chase at current levels.
Metals are smartly holding up. We saw marginal rise for the metal index in this during this week, while all the other index, except for FMCG, which did very well, have taken a hit. Now, for metals, if we are holding at these levels, can we expect this rally to continue for the metals, or if there is dollar strengthening up in the US markets and against the major currencies? So, what is your view on the metal space as such?
So largely we have been sort of overall cautious on the metal as a pace, largely because of the kind of volatility the sector sort of undertakes or happens to the sector. Now, what we have seen is that, see, for metals, China is obviously one of the biggest producers overall, and China is committed to a 6% kind of a GDP growth rate. So what this implies is that you will see a decent amount of demand, especially for industrial commodities from China. So it is possible that a lot of these metal prices would remain firm for some period of time. But our sense is that from an investor perspective, I think if somebody can sort of withstand the volatility, what metal offer, they can look at metal. But generally, we have seen people really do not have that kind of appetite. So, which is where I think if you have to look at from a cyclical place, I think cement is one of the best place to look at. What we have already seen in cement is prices overall has been pretty good in the last 2-3 quarters. There has been a marginal decline. Last quarter, we have seen a pickup in volumes. And with the kind of budget what we have got, the kind of infra push which is expected to happen going forward, I think cement overall is a good play from a cyclical perspective. And most of the cement companies have sort of cleaner balance sheet. Their capacity utilization is quite high. So you really do not have a risk on the balance sheet side. And if capex is pushed, our sense is that both prices as well as volume could remain firm. So I think from that perspective, cement offers less volatility and is a better structural play to sort of look at. And this is not one of the commodities which get disrupted because typically for cement, the economics do not work beyond a certain kilometer because the commodity is bulky in nature. So that way, I think cement is a relatively a lot more better sector if somebody is chasing lesser volatility.
What's your view on the scrappage policy and what impact do you see of this policy on the auto space?
So I think, see, auto overall in general, we have been negative as a pack, although we have seen a good bounce back in terms of overall sales. But I think our structural negative stems from the fact that the industry sort of underinvested in terms of technology to take on the EV risk. So that's a sort of a structural risk. I think the scrappage policy is a sort of a diluted one where we were expecting that the government will come up with incentives for scrappage. But I think we all understand that the government finances are also tight. So which is where they've left it to the auto OEMs to sort of give some discounts for scrapping their vehicles. So, and also the policy implementation is going to take time. So you will not see meaningful impact in earnings, even if there is a sales bump up because of scrappage. I think from 23-24 onwards is what you're going to see some impact. So that way, the policy offers a little help to the sector. I think where we are positive in the auto is largely the CV as a pack, because if so much of an infrastructure spend is going to happen, especially for I think CV players, that's a good amount of opportunity which can come up with. And then you have OEM players which are sort of less or which are expected to sort of get less disrupted because of EV. I think those are the players, especially tire players, because come what may, whatever be the technology, I think tire players will have a role to play post EV scenario also. So I think tire as a segment looks attractive from that perspective.
ITC up 10%, HUL up nearly 4% this week. FMCG space is buzzing, as you have always been positive on this space. And you just now said that this is a time because they have been beaten down, and this is a time to really enter this space. What would you do in ITC? I mean, do you see more steam left in HUL and ITC both?
So largely, if you look at, we have seen a good amount of bounce back in ITC. I think in this week, the stock has done quite well, up nearly 10 odd percent. But largely, I think if you have COVID-related restrictions, then I think the volume recovery in cement will still take some time. What the company has already highlighted is their dividend policy, which is positive, which is already out. Otherwise, I think any kind of a demerger also probably may not is going to really help because all the other businesses are sort of capital intensive in nature. The stock has been sort of relatively cheaper, and we have seen value-oriented stocks sort of doing well, and I think that is why probably ITC also is sort of doing well. But within FMCG, we like more of food-oriented companies, the likes of Nestle, some bit of HUL, Dabur, then Zydus Wellness is something which we like. So I think these are the kind of names which we like, and I think if the crude also sort of softens a bit, that also sort of takes some pressure on the packaging cost and other cost. So that way, and I think in addition to that, our sense is that if monsoon expectations turn out to be good, I think for FMCG, it's a sort of a positive surprise because that will allow them to sort of undertake price hikes. Otherwise, if the monsoon is deficient, they will have to only rely on volume growth and not pricing growth. So that way, I think FMCG looks attractive given the fact it hasn't done well, and you have levers which can sort of work in their favor.
Do you like power space, Pankaj?
So in the power, if you look at the entire, I think structurally this space is sort of witnessing a lot more challenge. One, if you look at historically, power has been produced at a single place and consumed everywhere. Now with the sort of advent of solar power, which is as competitive as the thermal power, what we have seen is that power will be sort of produced at various places and will be consumed at various places. So the entire dynamics of the sector is undergoing a change. In addition to that, I think the challenge is that eventually the collection resides with the discoms in terms of what kind of efficiency they have. So overall, the value chain is still choked from that perspective, and government has been taking various measures to sort of declog that. But my sense is that so besides being these stocks being cheap or below book values, I think structurally I'm not positive on any of these names, largely because while power demand is up, but then again I think the cost per unit is going to come down, or you will continue to have that kind of a pressure. Globally, the cost is closer to zero for a lot of solar-based projects. So from that perspective, I think this sector is. And in addition to that, one also needs to understand that if the battery cost keeps coming down, I think solar plus battery combination can further bring down the cost structurally, and which is where other sources of power, especially through thermal or other, I think would struggle. So structurally, I'm not positive on any of them. From a shorter term perspective, some of them have performed, can perform more, but these are not portfolio stocks to be chased.
Crude at 70, ethanol in news. What will you do on the sugar stocks?
So one is, I think the government has clearly realized that given the supply OPEC is sitting on, they're still not sort of releasing that spare supply. Yeah. So one way is to sort of curb that is to increase the blending of ethanol, and which is a sort of a multi-fold benefit because one, you can divert excess sugar for producing ethanol, and which you can blend. Now, for sugar companies, their ROCs are very good, and if the blending goes up, their proportion of ethanol to overall revenues will also go up. So, quite positive. But I think the only negative is that 85% of their revenues is coming from sugar. You don't expect sugar to sort of to be consumed more by people going forward. But ethanol is a decent lever to look at, and which is where most of these stocks are trading at 5-6 times kind of a multiple. And FCF yield is good. So I think if there is some value segment to be looked at, I think sugar is the only space which is from a value side looking quite attractive given the fact. So power is also sort of a value segment, not a growth-oriented sector. So from that perspective, I think sugar has got the right credentials in terms of government policy support. They have multiple benefits for the farmers as well, for the economy as well, for the environment as well. So I think so that is the probably one good space which can be looked at. And with kind of multiples they are commanding, I think they can offer a decent amount of upside for a year or 2 years or even longer.
So which stocks would you bet on in the sugar space?
So in sugar, we like most of the names because most of them are sort of quite cheap, trading below book values, I think, except Balrampur Chini. So largely, I think right from Balrampur Chini to Dhampur Sugar to Triveni, I think we like all the names. So these are sort of buys in our sugar space. And I think structurally, government is pretty positive on them. And if 20% blending happens, which is what we expect tenders will be out, I think that's a pretty positive for entire sugar companies.
Strategy for next week, Pankaj?
So I think consolidation is expected to sort of be there. We have got a number of US related data expected to be out, especially the US GDP. The housing data is expected to come out, plus other data is expected to come out. So a lot will depend on how. So if these data are stronger, probably the yield could sort of inch up to further higher or to normal pre-COVID levels. Mm-hmm. That might sort of cause some volatility or some extended consolidation in our markets. But I think one should realize that these are sort of not a problem where one should get scared of, because if the economy is rebounding well, whether it is US or whether it is our economy, I think definitely markets are going to take it in a positive stride, although short-term corrections cannot be ruled out. Mm-hmm. And so consolidation is what we'll expect, and defensive is what we would expect it to sort of do well in this scenario. But I think these are the times if somebody has missed the rally, I think these are the times to sort of lap up stocks, the defensives and the mid caps and small caps.
Thank you, Pankaj, for being with us. Thank you for your time.
Thank you so much.
Thank you so much.